Causes of the Great Depression. The economy of the 1920s wasn't very diverse. Basically, the economy was in a dependent relationship with the construction and auto industries. It couldn't stand on its own. Though a few new industries came into play and tried to pick up the slack, they never made much difference. The credit system was also a major flaw. Small banks were making too many loans, and citizens were struggling to pay them back, and on the other hand, some big banks foolishly made loans while carelessly investing in the stock market. There was overproduction of goods, but people weren't making enough to purchase the goods. Production was up and money was down. About half of American families lived at or below the poverty level in 1929. International trade was really weak at the time for America. European markets were producing more goods. The economy was steadily declining because of World War I debts. Needless to say, there was a drop in demand for American goods. After World War I, many countries involved with the Allies owed massive debts to American banks. Although these countries couldn't pay back their debts, the U.S. government refused to relieve them. Some friends we are. The government began making loans to European nations so that they could pay the war debts. Obviously, this only created more debt, and many countries defaulted. Contrary to popular belief, the Depression wasn't solely caused on the crash of the stock market. The crash just started a domino effect that eventually exposed all the problems in the American economic system. Reactions to the Great Depression. President Hoover tried to revive confidence in the economic system as a first response to the Depression. The agricultural economy had begun to struggle even before the Depression, and Hoover concocted the Agricultural Marketing Act. This act established a farm board that would make loans to marketing cooperatives or set up corporations that would buy the excess goods in order to raise prices. Another thing Hoover did to help farmers was institute the Hawley-Smoot tariff. This tariff was meant to protect farmers from international competition. Both of these attempts to help farmers ultimately produced very little aid. Hoover also instituted the Reconstruction Finance Corporation. This organization was a large scale and meant to provide loans for struggling banks, railroads, and other businesses. This program also failed in the end. Now it's time to move on to the next point.
The New Deal. The New Deal refers to the Roosevelt administration. It also refers to the acts put in place to try and save the United States from the Great Depression. Some of the first things the president wanted to do was to reassure the citizens and help restore confidence. To accomplish these goals, Roosevelt enacted the Emergency Banking Act to protect the larger banks. The smaller banks were failing, and he didn't want the larger ones to go down with them. It ended the immediate banking crisis, but more measures had to be taken. Roosevelt passed the Economy Act to help reassure the public that the federal government was going to be okay. The Glass-Steagall Act was passed so the government could put an end to bad or irresponsible speculation by banks. The Federal Deposit Insurance Corporation guaranteed that if a bank would fail, investors' money would still be secure up to $2,500. To help the citizens, more measures were taken. Federal emergency relief gave money to states to help relief agencies. The Civil Works Administration gave people temporary jobs or projects. The Civilian Conservation Corps helped young unemployed men by giving them work in national parks and helping build revisions, planting, and helping parks. He set up help for agriculture with the Agriculture Adjustment Act, which told farmers how much to produce. It helped bring a rise in prices for the farmers, but later the AAA's power was taken away because the Supreme Court ruled that the government didn't have the power to force farmers to limit their production. Other acts to help poor farmers included the Resettlement Administration, the Farm Security Administration, and the Rural Electrification Administration. The New Deal ultimately made the Democrat Party a major political force.
Compare the Great Depression to the economic downturn that started in 2007-2008. Are there any similarities or differences? The root cause of the economic crisis of 2008 was faulty mortgages. The banks were giving mortgages out to people who couldn't afford to pay them back. Eventually, this caused the value of the mortgages to completely dissolve. Businesses began foreclosing overnight, and the number of people in debt was devastating. The Great Depression of the 1930s had similar causes, mainly in the defaulted credit system. Banks were giving out loans to people who couldn't afford them, which eventually caused many to go into debts. It started with them giving loans to farmers, then escalated to others. And due to the lack of money coming into the banks, many of them froze.
Well, a lot of loans were made. They were getting people who should not have had loans to start with. They were given monies. They would know there's no way they could repay this loan, or at least wise would have a hard time repaying this loan. And they were just poor quality loans to begin with. And so there again, you know, you made a loan, they couldn't repay it, so consequently the association or whomever made the loan would have a problem. And then that created, you know, one thing sort of mushroomed. It just blew from one thing to another. It created a situation where, you know, with the lending aspect, it reduced the values of properties that people have had, and they were basing it on for many, many years. And
How is it reducing the value?
well, when people couldn't pay the note there again, and it was foreclosed upon, or they turned it back in voluntarily, everything had to be reappraised after it was turned back in, and the values would be dropping as the appraisals as the properties were turned back in. And that had a direct effect on the whole economy because the values of all the real estate was dropping drastically over time. Some areas a lot more than others. I know in California it was really bad. Arizona was terrible. Florida was disastrous. Properties just dropped in value to almost nothing, and this was a direct effect of the mortgage. And these mortgages that the people lost their properties and what have you, and it was all turned back in. So you had a flood of houses on the market at that time, foreclosed properties, and people picking things up. They were trying to pick up commercial and residential primarily at pennies on the dollar, so to speak.
You must compare the New Deal to recent attempts to counteract the recent economic downturn. Are there similarities? Are there differences? Roosevelt and Obama both modeled their economic policies on John Maynard Keynes' economic theories. His economic theory basically states that the federal government takes money out of the economy and puts it back into other areas of the economy that are lacking. The Keynes economic theories advocated government spending. It states that government spending is necessary if high employment rates are to be maintained. Keynes also believed in stability in workers' wages and did not support wage cuts in general, which was something Roosevelt tried to implement into the New Deal. Roosevelt wanted the industrial workers' salaries to rise at the same time as prices rose. Obama and Roosevelt both tried to create jobs to lower unemployment and stimulate the economy. Roosevelt enacted the Civilian Conservation Corps, the CCC, to not only create jobs, but to help strengthen the environment. He had thousands of unemployed young men go to areas that had eroded over time, or areas that had been ravaged by the Dust Bowl in the United States, to plant billions of trees. This was a huge success for reforestation efforts. It also stimulated more local economies. Obama, on the other hand, created jobs in other areas of the economy. He gave loans to the failing car industry so that the companies wouldn't shut down and bring unemployment down even more. Also, this helped the car companies employ more people and bring down the unemployment rate. Obama and Roosevelt both tried to regulate the banking industry, although their approaches were different. Obama tightened the regulation on bank loans. He implemented a stricter loan policy and tougher credit checks. Meanwhile, Roosevelt put in place the Emergency Banking Act, which protected larger banks from failing because of smaller banks. This resulted in the end of the immediate banking crisis for the U.S. Roosevelt also put in place the Glass-Steagall Act, which prevented banks from loaning money to people that would invest money in risky business ventures, because that was a reason why many banks were in trouble. Obama took similar measures when it came to banks. He put restrictions on loaning policies that made it harder to loan money from banks and made it necessary for the loaner to have good credit.